Hi everyone, today we talk about more advanced and complex topic, private equity and venture capital investments. How to track your investments, plan for capital calls and capital distributions, and do tax planning. My name is Alex, I'm the founder of Nauma. We help people working in tech make better financial decisions. We had a really good learning session last week. Jen Zhengpan gave an overview and showed what it actually means to have private equity and venture capital investments in your portfolio and the complexity that this asset class comes with. The recording of the talk is available on our YouTube channel, and I highly recommend watching it before you decide to add this asset class into your portfolio. This asset class adds more complexity. So first, there are more challenges when calculating your returns on your portfolio, specifically IRR. You also need to manage capital calls and capital distributions when you manage your investments and plan for that. And there is also more tax planning, as capital distributions often create tax events unless you invest in early stage of VC funds, which are eligible for QSBS. In general, our recommendation is always keep things simple unless you absolutely can't. Today we will consider a sample family, an example, how you can manage your investments if you decide to include private equity and venture capital into your portfolio. So the family lives in California, which means that they live in high tax state. QSBS here is not recognized on the state level. The family has a net worth of $22 million. $12 million is stored in public markets, $6 million in primary real estate, and they have $4 million allocated in private equity and venture capital investments, which is 18% of their total net worth. But if you exclude their primary residence, it's going to be around 25%, which is a bit high, actually. In general, recommendation is to limit private equity and venture capital to maximum 10%, and it's a good guidance. This family invested in 4 VC funds, and these are just a sample and example. These are not real funds. Aurora Ventures Fund 4 vintage is 2019, so they committed $1 million into that fund, and most of the capital has been already called, so it's a closed fund, and we don't expect that general partners will call more. The expected TVPI is 3.x, and distributions are going to be between 2024 and 2025, so they already started. What is TVPI? So I put a formula here below. It's a total value to paid in capital. So you take all the distributions that were already made by the fund and residual value, which is still in the fund, and you divide it by the paid in capital, the one that was provided into the fund. So it's a metric that is used to understand the profitability of the fund. So because this is an early stage, some of the investments here will qualify for QSBS, so we'll keep that in mind. But again, it's not necessarily all investments, because if it's a seed stage companies or even Series A, then it might qualify for QSBS. But beyond that, it's not. And typically, sometimes funds, they have a mix of investments. So some investments may qualify for QSBS and some not. The next fund is Aurora Ventures Fund 5. Again, it's an early stage. Vintage year is 2023. The total commitment is $750,000, and 30% of that fund is already called. This fund has a 2.5 TVPI. This is expected return, which is expectation is provided by the general partners. The next one is Horizon Growth Fund 3. This is a growth equity. It's not QSBS eligible. Vintage year is 2023. The family committed $1.25 million, and they expect that more capital will be called in the next few years. BlackRock secondaries. So this is private equity secondaries. It's a smaller commitment, $750,000. No capital has been called so far, and its expected TVPI is 1.6% because it's a secondaries. So the total, the family committed $275 million, and the amount that is already called is $1.5 million. Now, as you can see, these funds, they have a different timeline, different capital call schedule and distribution, and that adds all this complexity. Now, you as an individual investor, you need to figure out how to prepare the capital, how to allocate funds, and estimate. What also is hard for you is estimating your tax liability when you receive capital distributions. Capital calls are typically not scaled, but for these, they're not guaranteed to be in equal parts. So general partners may call the capital at any time when they see a deal. But in this example, we will use a curve. We will say that most of the capital is going to be called in year 2 and 3, and less in year 1, and maybe just a little bit at the end of the fund. So it will follow this J curve. The family also has direct investments. They invested in 3 companies directly. So NovaGen, again, this is simple names to use as an example, $250,000 in 2018. And the current value, so here is $700,000. The exit is planned to be around 2026. So this is the expectation that is provided by the company. They think that they will be acquired, and multiple on invested capital, expected multiple on invested capital is going to be 3x. So what is MOIC? It's a metric very similar to TVPI. It says, but it's normally applied to individual investments rather than funds. So it's a total value, both realized and unrealized, and divided on the invested capital. The second company is True Harvest H Tech. So they invested $250,000 into that, and the current value is $300,000, and they expect 2x return in 2029 at the moment. So it's not guaranteed. Again, these type of things, especially in private equity, they're never guaranteed. The same applies to these funds. So it all depends on the state of the economy, on the market. But this is a expectation that fund managers share with limited partners, and you can always adjust that when you receive new information and see how it impacts you. So this is our starting step. So let's take a look now how we are going to add this data into the projection. All right, so this is our portal where we will work and add the private equity investments. Some information has been added, so I'm going to quickly show you what's already there. So for family profile, we entered the details of the family. They have 2 kids, Kevin, 13 years, and Steph, 10 years old. Then for the net worth, we already added their public market investments. So they have $10 million in taxable accounts. It's Vanguard, Charles Schwab, and there's emergency fund allocated environment, high yield savings account. For tax deferred accounts, they have an traditional IRA account, $1.2 million there, and in tax free account, they have $600,000 there. As you can see, financially, the family is doing really, really well. So this red line is top 1% of American families by net worth, and for their age group of 50 years old, they're way above the top 1%. Now they have a real estate, so they have a house which is currently worth $6 million. We added property tax, annual insurance, and annual maintenance, so that will help us estimate their expenses. They have 2 cars, and they have so there's a mortgage for the house at a very good rate, 2.65% fixed rate, which they refinanced in 2021, and they also have loans for their cars. We also added some basic living expenses and some of the things that are associated with their assets, such as car maintenance, mortgage payments, information. So that was automatically added, and there's estimate for the taxes that they pay, very, very low, because they don't have income. This is a financially independent family. They don't need to work. And there's some very first version of the financial projection that is built for their family. As you can see, their net annual cash flow is always negative. It fluctuates over time because they have different financial goals. So this is starting point for the family, and we just started to work on this financial projection. So you can see their cash flow in every year, taxes, and etc. So this is our starting point. So first thing we will do is that we will go into the model 2, calculate the net worth, and start adding venture capital funds. We'll add them as other assets. So I click here and click is add other asset, and the first one is Aurora Ventures Fund 4. So we are going to create a separate asset for each private equity or venture capital fund or direct investment, so we could easily then track them. So original, and for venture capital funds, we will use original commitments for now. So it's the family provided $1 million into these before, and we will keep it for now as maybe $1 million for simplicity. Let's keep this annual appreciation 0 for now. I'll talk about that later. And annual insurance, of course, and annual maintenance don't apply here. I will talk more about annual appreciation a bit later, and I'll show you the way how you can calculate that. So we'll click that, and because we already created a financial projection, so we're going to also add these assets into the projection. So always just click apply, and let it do. So now you see that there's one fund that has been added. So we'll do the same thing for other funds. Now I'll just pause the video here so you don't watch me doing the same thing multiple times. All right, so we added all venture capital funds and direct investments into Model 2 for net worth projection. So now the total net worth is $21.1 million. And I added 10% as annual appreciation for these funds. This is okay estimate, but I'll make a separate video and show you how to calculate IRR based on TVPI and the fund duration. There's a pretty simple formula for that, but we'll do that later. So the next thing we do is that once we finish adding these assets, we go into the financial projection, and you'll see that for each asset, there was a separate life event created here. So right now it's stored separately. In order to simplify management, we are going to combine all these private and venture capital investments into one life event. It's a personal preference. Different people may have different ideas how they want to do that, but let's first do that. And also ignore this net worth projection for now. So I think that it's going to be very, very super optimistic over time because we haven't stopped these investments. So what we're going to do, we'll take this first life event and we'll rename it, and we'll call it private equity investments, click apply. Okay, cool. And now we are going to actually move in existing other assets into this life event. So we're bringing Aurora, Fund 5, Horizon Growth Fund 3, BlackRock, NovaGen, True Harvest, click apply. All of them have been moved now into this live event. And now the rest is basically empty, so we just need to do some cleanup here really quick. Maybe later we'll just automate this process. For now we need to do it manually. Delete it and delete it. Okay, now we press save. Okay, save. And we have all our private equity investments in one place. So the next step for us would be to start adding capital calls and distributions into these life event, right? All right, the next step for us is to estimate capital calls and capital distributions. As you can see, we just added assets into our life events. There's no income, there are no expenses, therefore there are no taxable events here. So what we're going to do is that we will go into our Google Doc document where we listed all these funds at the beginning, and then we will add a row below. So merge that things. Can I do that really quick? So merge cells, and we'll start adding the information for each of the fund and try to estimate capital calls and distributions. For the first fund, Aurora Ventures, because all capital has been called, we're just expecting the returns, right? And because TVPI is 3.0, that means that we're expecting to receive $3 million between 2024 and 2029. So let's say that we will get 800K per year in 800K between in 2026, 7, 8, and 9 years, 2090, 7, 2028, and 2029. And there is no distribution. So this is going to be our distributions. Then there is no capital calls. For the second one, we'll do the same thing. Merge these cells, capital calls, and capital distributions. So what do we have here? So we committed $750,000. 225 already has been committed. And we have another, I guess, $500,000 that will be committed in the next probably 2 years, right? So it's going to be 529 total, and we distribute them, let's say $300 in 2026 and $225,000 in 2027. So this is for capital calls for distributions. So the expected TVPI is $2.5 million. That gives us $1.8 million total, and we will distribute them between 2028 and 2032. So that's 4 years. Let's do something maybe for 25 for $50,000, right? A year. I think that would be the right approach here. So let's keep it simple in this example. Now for the next one, so do the same thing, merge cells, so capital calls, capital distributions. 30% of the capital has been called, $375,000. So we need to just really calculate really quick how much is going to be called. So let's do. It's going to be a 125 minus 0.375. Will it calculate it for me? No, it won't. So I'll need to put it into Google because I don't know how to calculate anymore. $875,000. So we get $875,000 total. So we will distribute them. Let's say that we distribute them evenly in the next 3 years. That's going to be $291,000 annually. Okay, 291. Let's go for $1,000 per year in 2026, 2027, and 2028. What's about the distributions? Oh, okay, let's actually move it a bit for the demo purposes. 1 year earlier, 25, 2026, and 2027. For capital distributions, so TVPI is $2.2 million, so that's going to be $275 million total, which will be distributed between 2028 and 2032. For demo purposes and simplicity, let's say that they will be distributed equally, so that gives us $687,000 annually in 2028, 2032. And the last one is BlackRock secondaries. So I think you got an idea already how these calculations are done. So I'll just copy that. So for capital calls, okay, we need to call $750,000 as expected, and we will do that. Let's do it in 4 years. In 3 years, maybe do 250. Okay, in 2025, 2026, 2027. Okay, for distributions, if TVPI is 1.6x, that will give us something like $1.2 million total. And if we divide it on 3 years, that's going to be $400,000 a year, I guess, in 2028, 2029, 2030. All right, so, and then the last one, so this is going to be pretty easy because these are direct investments. So we just add below, merge cells. So it's going to be a 3x return on 250, so it's going to be $750K in 2026. And for true harvest, merge cells, it's going to be a return. So we invested 250, and it's going to be 2x. It's going to be $500,000 in 2029. All right. So now what we would like to do next is go and enter these numbers into the projection. So that will calculate taxes and cash flow for the family in these years. So I'll go to private equity investments, and let's go and do the first one as an example. We'll start with Aurora Ventures Fund 4. There are like 3 distributions on 2027, 2029, 8, and 2029. And we also, okay, so what we're going to do, there are 2 options. You can either add 3 distributions separately, or you can set a start and end date. I actually don't recommend setting start and end date because it might be confusing to understand the cost basis for these transactions. So we'll say Aurora Fund 4 distribution 2027 is going to be investment income, long-term capital gains, and the pre-tax value is going to be $800,000, and the cost basis, because it's a 3x. So what is the 803? So it's 266 cost basis, and then frequency is going to be 1 time. Because it's early stage fund, we expect that it's going to be QSBS eligible, so we set it to true, and then we click apply. All right, so now we got these cash flow on the line, right? And you can actually start seeing this in cash flow projections, and you start to get income tax estimate. So, first of all, let's go and add other. Let me show you the tax estimate here. So now cash flow, annual cash flow is positive for the family. You can see the breakdown here just for that life event. So they're going to receive $800,000 distribution from that fund. This is how the net worth is going to affect it, but we haven't stopped these assets yet, so this is not, I would ignore it for now. And then you see that their tax liability has been calculated and increased. So if we turn off their private equity investments, so you see this is how their tax liability is going to look like in a given year. Do we have a total here? No, we don't. So 9,000 in FICA tax, 12,000 in federal income tax, and 9,000 in state income tax. So total $30,000. But if we enable that one, so that jumps to more than $50,000 because we need to pay long-term capital gains in California. Right. So what we are going to do next, we will add other distributions for Aurora Fund. And I'll pause the video here so you don't see me doing the same thing again and again. But what I wanted to highlight here is that when you enter distributions, you would like to specify both distribution and cost basis of that, so that we could calculate what is the taxable income here. And also, if it's an early stage fund, you would like to mark it as QSBS eligible. It will reduce your taxes. All right, pause here. All right, we just finished adding all capital calls and distributions into the private equity investments live event. The key takeaways is that when you add distributions, set the income type to be a long-term capital gain, set the cost basis or the transaction, because that's important. And then if it's an early stage fund and investments there are eligible for QSBS, set this flag to true. It will turn off capital gain tax for federal taxes. And if you're still in California, the tool knows that actually it will calculate the tax there. So here's updated cash flow projection. As you can see with the private equity investments, there's a lot going on in the next 5 or 7 years. And we can easily turn it on and off, and just to see what's the impact of this live event on the financial projection of the family. So it's a very nice feature that we have. So in the process, we generated a lot of taxes. So and now we can analyze them and see these taxes on this tab. And again, you can just enable and disable this live event to see what's the impact of private investments on your taxes. And on the left, you can always see the breakdown for each of the year. And that hopes that it will help you understand the impact of your private investments on your portfolio. So going back, so I just wanted to repeat what I said at the beginning. Private equity, venture capital add way more complexity into your portfolio. You need to calculate your IRR, which is not that straightforward actually. You need to manage capital calls and distributions. You can do that in our tool if you want to. And there's more tax planning, as capital distributions often create tax events. I hope this video was useful. Let me know if you have any questions. See you in the next episode.